In the Market Master course, we want you to build a solid foundation to work from. Anything you do, if you're going to build a home, you've got to have a solid foundation underneath you, and it's the same way in trading. You need to understand market and single stock analysis. So we're going to talk about technicals, and technicals are a way that you can define your risk to reward, but you've got to be able to understand them. What is impactful? What really matters? And then eliminate the noise. Put together a trading system that is tailored specifically for your needs. All of you should be thinking through or processing a new trading system. If you're new to Maverick, this is a system that you're going to work from. And this should be something that should be tested a little. You're going to find tweaks and changes that you want to make, but start to put together that trading system. Eliminate as best you can the emotional aspects of trading. Emotions, if you think that you can come into the markets and just kind of feel your way through them, it will get you into a lot of trouble, because when emotionally you think it is crazy to buy, that's usually when a great buy setup's there. When you finally feel like, okay, now it's time to buy, everything's great, well, that's the top, and so forth. Emotionally, the markets will push you around, and so you've got to eliminate emotions and make this very systematic. We want it to be, I mean, that's the great thing about a chart. A chart doesn't have emotion in it. You say, I'm going to enter here, I'm going to stop out here, I'm going to target here. There's no emotion behind that. Now, managing that trade, sticking with that plan, that's where emotions start to kick in. Understand past mistakes, how to avoid them in future trading, and learn the ways of professional traders. So now let's start with session 1, our agenda, and within this we're going to start with the Maverick Way. As I said, the Maverick Way will be a little different segment, but we're going to do them at the start of every one of these sessions. And today's Maverick Way, so the Maverick Way that we're going to do today is focused on probability, not prediction. And there's a big difference between those. So high probability trading means putting our money to work when we have enough factors to suggest a meaningful move in one direction and is justified by the amount of risk we're taking. In other words, we want to feel confident that the reward potential outweighs the risks that we're taking. But there's always a risk. You cannot eliminate risk. You can only manage it. So as a general rule, the higher the number of factors suggesting our trading outcome should be successful, the better the odds of success. We can only skew the performers, though, so much. You'll notice up here in the top right corner, I just put in a bell curve. This is statistics, right? So here's your one standard deviation. This is 68% probability that it's going to occur. And that didn't show up very well. Let me just tweak that color. But here's your 68% probability. And most of the time, the performers you take are going to follow this bell curve. You're going to have some high performers and you're going to have some low performers, but for the most part, or 68%, you're going to be in that middle range. Well, if you can learn high probability trading, you can skew this in your favor. You can skew it so that it's called in statistics a fat tail, where there's a bigger probability of having high performers and a lower probability, you'd have a skinny tail over here, a lower probability of having low performers. That's all we can do as traders. If you think that we can get everything to become a high performer and eliminate this side entirely, you're kidding yourself. It's just not possible, okay? There are just too many moving parts. There's no way that you can predict. If I enter a position in XYZ Corp and then overnight there's a surprise announcement by the Federal Reserve, that's going to impact my trade, right? I can't control all of these factors. I can skew the statistics through technicals and some of the things we're going to talk about. I can improve my probability, but I cannot make it, such that I eliminate all risk and just have massive rewards. It's just simply not possible. But what we want you to focus on is improving this as best you can. and thinking about reward and risk, because there's always risk. Well, we've got to think about what our reward is, what it realistically is in each trade we're taking, and then follow that game plan. This is designed to increase our odds of success in the markets. So, when we think about improving our odds, it does not mean that we can predict the future. New traders often develop this misconception that they have to predict the future in order to make money. It's probabilities, it's not predictions. As I said before, we just can't be right every time. It's just not possible. So there are no stand stock picks 100% guaranteed. If you think that there's anything that's guaranteed in the financial markets, you're kidding yourself. Even the things that are considered riskless, they'll often refer to U.S. government bonds as riskless. There's nothing that's riskless. What if the government shuts down? What if people lose faith in in the dollar? Yeah, it's low probability, but there's no such thing as zero risk. There's always some risk. It's quantifiable somewhere. So Maverick says we'd rather be profitable than right. And ultimately, this is an emotional component we're going to talk about right up front. Emotionally, a lot of people would rather be right than make money. In other words, they're going to stick with losing positions because they're absolutely convinced that they're right and the market's wrong. They'd rather be proven right than profitable. And this is similar to arguing with your spouse. Now, I could argue with my wife and perhaps eventually be proven right in whatever that argument is. But even if I eventually prove that I was right, this is like trading, getting back to break even. Wasn't I still wrong? Because ultimately, there's no winning. If my wife is losing, then I'm losing. That's the point, right? And so in trading, is it about being right or is it about making money? A lot of people will come out with a thesis and they'll say, here's how I expect it to play out. It's okay for that thesis to be wrong. Nobody's going to, at least here at Maverick, we don't criticize one another for, we don't say, what in the world were you thinking? If you have good money management principles, then you can trade almost anything. And that's the reality. You can have your system and trade any strategy you like as long as you have solid money and risk management. Now, if you start holding a bunch of losers and those losses are just getting gigantic, then now all of a sudden we're going to say, what in the world were you thinking? But if you've got a good risk management, good money management, figure out the systems that you like. Risk management is paramount. It is so critical to long-term success. The very first rule in trading is protect your capital at all costs. So start with the worst in mind. What's my worst case scenario? Every trade should say, what do I lose if I'm wrong about this? And then think about how much capital you're willing to allocate. Now we'll talk about capital and how much money to put in each trade and what some professional traders suggest as far as that's concerned, how much exposure per trade. You certainly shouldn't be putting 20% of your capital at risk in every single trade. A small losing streak and you're blown up, right? So, there are some principles that you can follow, but if you start with the worst case scenario in mind and improve upon that, you do great things in the financial markets. So start with the worst case scenario, improve upon that situation, figure out how you can find reward that outweighs those risks, and you're going to be in great shape. Unfortunately, some people equate trading with gambling. We don't look at it that way. Educated traders should understand it's risk, it's developing skills, strategies, and you manage it. So maybe if you could equate it to poker, poker, a game of skill or something like that, where there's actual advantages to knowing what you're doing versus those that don't know what they're doing, and those that make money are those that can keep their emotions in check, just like at the poker table. I'm okay with that analogy, but if you think that it's kind of a get rich quick or hit it big, and you're going to be disappointed. Trading, real profitable trading, is about turning consistent profits. It's not about throwing everything out there and hoping that this is the one, this is the one scenario that's going to pan out. That's just not a good scenario to be in. So technical analysis is what we use to define these things. We read the signals, cues in the chart, and what drives technicals are you, me, and everyone else that is making our investment decisions. And built inside of all of that is human nature. So we as individuals, to predict one person is nearly impossible, but to predict what a group will do, or a majority, now all of a sudden that's possible. And so the market doesn't repeat perfectly, but it has a nice rhyme to it. Meaning that, given certain circumstances, the market as a whole is likely to act in this manner. And so technical analysis is repeating patterns in the charts that occur over and over and over again. If a stock breaks out sharply, well, a lot of people say, boy, I'd love to own that stock. I'll buy it on a dip. The people that are short that stock say, oh no, I'm losing a bunch of money. I'll buy it back on the dip, and so forth. And so there are actual reasons why buying a dip after a breakout can make a lot of sense, because human nature tends to push people towards buying the dip at the next opportunity, and so forth. And it's just these repeatable patterns that give us a chance to jump on and really manage our risk appropriately. So here's an analogy that Rob gives, and I think it's fantastic. Again, this is the Maverick way. This is a different way of thinking. So a trader takes 10 trades that all have good setups. Now, we wouldn't take them if we didn't believe in every last one of them, right? All 10 are fantastic. They're perfect. They're beautiful positions. That's why we're confident. That's why we're taking these trades. As I said before, do you think all 10 are going to pan out? Well, statistically, it's going to follow the bell curve to a certain extent. You're going to have some low performers, some average performers, and so on. If a stock breaks out sharply, well, a lot of people say, boy, I'd love to own that stock. I'll buy it on a dip. The people that are short that stock say, oh no, I'm losing a bunch of money. I'll buy it back on the dip, and so forth. And so there are actual reasons why buying a dip after a breakout can make a lot of sense, because human nature tends to push people towards buying the dip at the next opportunity, and so forth. And it's just these repeatable patterns that give us a chance to jump on and really manage our risk appropriately. So here's an analogy that Rob gives, and I think it's fantastic. Again, this is the Maverick way. This is a different way of thinking. So a trader takes 10 trades that all have good setups. Now, we wouldn't take them if we didn't believe in every last one of them, right? All 10 are fantastic. They're perfect. They're beautiful positions. That's why we're confident. That's why we're taking these trades. As I said before, do you think all 10 are going to pan out? Well, statistically, it's going to follow the bell curve to a certain extent. You're going to have some low performers, some average performers, and some high performers. That's just the way it's going to go. If you're really skilled, you can skew that a little bit, where you get a fatter tail on the high performers and a skinnier tail on the low performers. But ultimately, out of all of those 10 trades, you had the same belief in all of them, yet some of them are just not going to work right from the start. So you take them, they're bad trades, and they're losers. 4 trades out of your 10. That's a pretty big number. That's significant. This emphasizes the point behind we're not perfect at predicting what's going to happen. We are not predicting the future. Instead, we're managing risk and trying to improve the statistics in our favor. Out of those 10, 3 to 5 are small gains or break-even type of numbers, but you get a couple of outperformers. And this is really where you make your money. Over 10 trades, let me show you the difference between a professional trader and a beginning level trader. And I know from experience, when I first started in the markets, I thought a certain way, which is very, very bad. And I'll bet you 90+% of all people are as naive as I was about the markets. Because I came into the market and I said, well, if I take 10 trades, what if I can take profits in all of them that show a profit early on, and then hold the losers until they come back to break even or profits. And if I do that over time, I'll always make money, right? Now, trust me, it never worked. But if I take 10 trades and I think, okay, 3 to 5 of them show a small gain, I lock those in. 1 to 2 could have been big winners, but I don't hold them long enough for that, right? I take a small profit. So essentially, I've locked in a gain on, let's say, 7 trades. Does my success rate look pretty solid? Yeah, I made money on 70% of my trades. What's the problem? The problem is that left 3 out of my 10 trades that are bad. Now I'm giving you the benefit of the doubt and saying that you had 7 small profits. Well, 7 profits, let's say you made $1 a piece. You've got $7 in gains. First of all, these losers, they can turn ugly. Let's say that each one of them is down, $1. Okay, they're small losers at the start. Well, you're only down 3. That's okay. If you cut them off to small losses, you could be on to something. But that's not what we're going to do, right? Remember, my mindset was take anything that's a profit, hold anything that's not until it turns into a profit. What a bad idea. Next thing you know, they're down 2. Then they're down 3. And they're down 4. Now, let's say one of them goes back to break even. So one of them does, go back to break even. Okay, we'll give you the benefit of the doubt on that. Sure, some of them will come back. What's the problem? Still have 2 really bad trades. And next thing you know, trends are severe. Trends go to obscene numbers. We say as traders that stocks will go to the obscene number, meaning the number you could never have predicted and seems completely, out of this world in terms of its direction and magnitude of move and so on and so forth. And frankly, they'll do that often. So the next thing you know, you're down 15 points in each of these. I mean, that would not be shocking to me at all. Now, one of them came back, maybe 2 of them come back, but the other one just blows up. And if you take 15 in losses, eventually you just throw in the towel, you capitulate as we call it. You lost 30 and you made 7. Is that a good system? Well, of course the answer is a resounding no. That's what people try to do. They think, well, it's not a loss until you sell it. All of those justifications, don't do that. Instead, let me talk to you about this breakdown. So if you look up here at the bell curve, I talked about the 68% probability. So out of those 10 trades, we can say that 6.8% or 6 point, it would be 68%, but 6.8 of our 10 trades are somewhere in this kind of average performers. Okay, a tiny loss, a tiny gain, but we'll call them roughly break even. If we're just using regular statistics, that leaves 3.2 left over, which half would go over here to bad performers and half would go over here to outperformers, strong performers. Now when we look at this, if you're not improving on your statistics, hopefully you can. Hopefully over here, you have 2 and over here you have 1.2 or whatever, right? So you have fewer potential losses and more potential big gainers. But let's just say we follow the statistics. That means for every 10 trades, you're going to just kind of have mindless trades in about 6.8 out of those 10. You could have a few that would be disastrous, and you could have a few that would be gigantic gains. Your job as a trader is to lock these off, is to never let those losses mount. So the great thing about spread trading and some of those things is that they have a well-defined, this is exactly how much you can lose. If you can cut off the 1.6 out of every 10 trades, they're going to be gigantic losses. Say you roughly break even on the 6.8 over here. Here's where you make money. It's basically 1 to 2 out of every 10 trades are the big winners, and that's where you capitalize. So you lose 1 over here, you break even on these, and you make 5, 10, or whatever over here, and now all of a sudden you have a solid trading system. It's about risk and money management. What we will emphasize always is good risk and money management. Take small losses and big gains, and you'll see the benefits of that, trust me, over time. Probability or profitability comes from trading high percentage trades where you have an edge, and managing risk, meaning holding your winners and cutting your losers. No single trade is meaningful. Out of those 10 trades, do you care which stock it is that made the big gain? Does it really matter to you if it was Apple or IBM or Yahoo or whatever? Do you care about the company name? Of course not. What we care about is the profit. So whether you were bullish on Apple and it ended up as a break even, and Yahoo's not the sexiest name, but it was the one that was the big performer, who cares where you got your money from? No single trade or idea is meaningful unless you screw it up. Consistency is the key, and that is the Maverick way. Now let's jump into the next part of our course. We're going to talk about trend following proof. So what is proof? What do we have backing us up that emphasizes that following the trend is beneficial? Now, do we have any statistical data of this? So let's jump in to trend following proof. Let's talk about whether we actually have studies and statistics that back up that trading with the trend is beneficial. Well, there's been a lot of research on this topic. We're just going to name a few. A Century of Evidence on Trend Following by Covell, Trend Following Performance, Risk, and Correlation. We're going to make these downloadable in your Session 1 handouts. So if you want to look at these studies, read through them, look at some of the statistical data and so forth, feel free to do that. We're going to hit the high points today. So first, momentum study. This was a study that went over a 30-year period, and it included all stocks on the New York Stock Exchange, the NASDAQ, and the Amex between 1965 to 1998. What it did was simply looked at the stocks with the highest and lowest returns over the past 6 months and measured the return over the next 6 months. Pretty simple, right? What's going up and what's going down, and then how did they perform after that? What it found were that the top performing stocks tended to outperform the overall market by 40 basis points. And then to make it even more strong, the best performers, the cream of the crop, the top 10% of stocks, beat the bottom 10 by 123 basis points over the next 6 months. Do you see how when we talked about the Maverick way and we emphasized that holding your winners and cutting your losers, what this points out is out of that 1.6 out of every 10 trades that you take, that analogy we talked about, the underperformers keep underperforming. The outperformers keep outperforming. So if you think you can just hold on for dear life and it'll eventually come back, you're most of the time going to be disappointed and going to have, scars to show for it. The top 10% of stocks were positive 66% of the time over the next 6 months. So statistically, that's a very significant number. 66% of the time, they were positive. You could have basically thrown a dart at the top 10% of stocks and found good bullish candidates that outperform the market. Next study. During bull markets, or this is just an emphasis on statistical data, during bull markets, 64% of stocks move higher, and during bear markets, 72% of stocks move lower. Now this speaks to a couple of different things. First of all, when you're in a bull market, a rising tide lifts all boats. But you can see that the correlation is not quite as strong as when you're in a bear market. When you're in a bear market, they'll throw, as they say, the baby out with the bathwater, meaning that the correlations increase towards 1. You have more stocks acting like the market, and because of that, in essence, you get a scenario where especially when you're in a bear market, the probability of continuing to see downward pressure in stocks is increased. So you want to trade with the trend. If you're in a bull market, you want to be more of a buyer of stocks. If you're in a bear market, you want to be more of a short seller, buying puts and so forth of stocks. But that's especially true in bear markets. It's even more statistically significant. What's the explanation for that? There's a couple of different things, but the biggest explanation, I think, is forced liquidations. When a market's going up, people are doing okay, but there's not kind of forced buying that takes place, right? People buy at a more measured, slow pace. So if markets are going up, people say, well, I'll buy a little bit here, I'll buy a little bit there. When markets are going down, there's forced liquidations, meaning it's emotionally, it's fight or flight. You're either going to stick with it and fight it out, or you're going to bail. And a lot of people just flat out bail out. Forced liquidations from brokers. If people are trading on margin and really levered up, then as you get a sell-off, it forces more selling and more selling, because these brokers are forcing people out of their positions so that they don't lose money and so on. So there's more of kind of the animal spirits take over in a bear market, and that's why those correlations will be even higher. Another trend study. What if you bought a 7% move in the markets and hold for 4 weeks? Your win-loss ratio was 59% and the profit factor 1.34. So a 7% move in the markets. Now I know this is another example of, I thought, well, if the markets have gone up a lot, then I should bet against them, because what goes up must come down. Boy, is that bad, because what goes up tends to go up further, right? Most people think something of a big move in the short term should fade away, and that's just not the case. Buying begets more buying, and selling begets more selling. So if you move up 7% in a hurry, you're probably going to move up more, as is shown there. What about just going with a steady trend? What if you just buy a rising stock one day before its earnings report, when it's above its 50-day moving average, and then sell it the next morning? In other words, is the earnings report, is the data, the news, more likely to be positive or negative when the stock's already rising? Well, the price action suggests it probably is going to have good news. In fact, there may be somebody that knows something that I don't, right? They've been buying because they've been doing channel checks, and they've been seeing that, there's a lot of demand for X product or whatever. But the point is, the stock's rising. That's a sign of strength. So, win-loss ratio better than a coin flip, profit factor strong, annualized return very solid. The point is, trading with the trend, even going into earnings reports, is a good idea. What about statistical analysis? Do we want, well, we want to put as many factors in our favor as possible. The statistics suggest that buying winners and selling losers gives you statistically some edge. So, psychological factors cause us to make different decisions, and that's exactly what we have to avoid. We want to go with the trend. The very best trends are the hated trends. So if there was a recipe that I love, it's when everybody thinks that something has gone too far. Everybody's bearish on the market and thinks that the market can't go any higher and so forth. We've seen that over the past few years. This has been the most hated bull market maybe in our history, because we saw an implosion in 2008. We saw a financial crisis, and people just weren't prepared and ready to believe that markets could go significantly higher. And every step of the way, everyone's wanted to call for a bear market. That's a perfect environment. You've got the trend in your favor and everybody hates it. That means you've got a lot of ammunition and potential buyers that will come back into into those stocks. Now, we're going to dive into trend recognition. So trend recognition is about identifying. We've just talked about the proof. Do we think there's an edge, an advantage? Can you skew the statistics a little in your favor working with the trend? Absolutely. And a hated trend is the best trend, right? So how do we recognize these? Well, uptrending price action is all about higher highs and higher lows. As you look at the price action of an asset, higher highs and higher lows is the purest sign that there is demand for the stock. Meaning, there's demand because the price went higher than where it was before. There's demand because as the stock pulls back, the buyers are more aggressive and create a higher low than where it bottomed out before. This is the purest sign of demand that you can find in the chart. And in fact, in technical analysis, I do follow some things. I'll use Fibonacci lines. I use Bollinger Bands to measure some statistics on a chart and do some things that way. But I have to tell you, really technical analysis comes down to price action. I mean, price and volume are what's absolutely happening. Everything else takes its cue from that, right? So price action, I mean, that's supply and demand. You can't see supply and demand any better than just simply looking at what the price of the asset has been doing. So what do we do if we find this nice uptrending price action? Well, we look to trade with the trend. So that could include buying pullbacks to rising moving averages or to trend lines, looking for where it bases up here, and then buying breakouts, looking for triangle patterns. Maybe it creates an ascending triangle or whatever, buy the breakout, symmetrical triangles, whatever it may be. The point is, we're looking for buy points. Generally speaking, we avoid selling short in uptrends unless very experienced, well capitalized, and you're very good at counter trend trading. We've already said that your statistical probability of being great at counter trend is just working against you. It's just flat out not probable that you're going to do great at it. I mean, you have to be so good to overcome the statistics that are working against you, right? And a lot of times we cannot explain why something's doing what it's doing, but you don't need to explain it. You need to see profits, right? And so, like I said before, the hated rallies, the ones that seem so illogical, those are my favorites, because if nobody believes in it and the trend is working, you're onto something. Well, in a downtrend, everything changes. This is where you should get defensive. Should you be buying and trying to buy stocks that are getting pummeled? They call this catching a falling knife, which is exactly what it is. If a knife is falling, I'd rather let it land, stabilize, and then go pick it up. I would not want to try and catch it out of the air, because the risk to reward of that, yeah, I'll look really cool to my buddies if I catch it on the handle, but guess what? If I don't, I've got a doctor's visit, okay? And that's what trading in a downtrend is. You're basically trying to look cool. You're trying to call the bottom and be that guy that's able to say, well, I bought it at the perfect level and I picked the bottom perfect. Well, you might be able to pull that off on occasion, but it's not about being right. It's not about looking cool. It's about making money. And so I'd much rather not attempt this if at all possible. Instead, let's let that trend work in our favor. What is the trend? How is it defined? Well, obviously, every time you rally, you're weaker and you stall out at a lower level than where you were before. And every time you fall, you're falling to lower prices than where you were before. There's no greater emphasis about the demand, or in this case, supply of the stock, than simply price action. There's too much supply. Too many shares that want to be sold and not enough that want to be bought. And until that changes, this stock continues to fall further and faster to the downside. So let's look to short the rallies up here at resistance zones. Let's look to do that against trend lines. Let's look for basing patterns, low bases down here, or descending triangles or symmetrical triangles. But let's look to profit from downward movement. The stock price, does it really matter to you if a stock is priced at 50 or 90 or 70? Does it matter to you what the company name is, or does it matter whether or not you can identify price levels and profit from it? So, it's probably good habit to not even care in all, seriousness. Now, it's kind of funny how things evolve and change. We were talking about this in the Maverick offices, and Rob was talking about how years ago he would listen in on conference calls and be like, well, I really like the way this is going. The company looks really poised for success into the future and so forth. And then, realistically understanding that just didn't create any edge for a trader. And we kind of joked there was an individual that would trade, and he'd be like, oh, I really like this company, it has huge potential, and then ding, he was out 10 minutes later. I mean, if you're going to make a fundamental argument for a business, you better be a long-term investor. So it's all about time horizons, time frames, not even caring about things that don't impact you and don't really influence your trade is probably a good thing. And focus on the things that are going to pay off. And that is shorting the hated, the stocks that everyone thinks should rally, but they're in a downtrend. Those are the ones I want to be short of. Those are the ones where I have a lot of potential. Then you get into stagnation, sideways ranges, relatively equal highs and lows. There's no well-defined trend. Some will call this a sideways trend. I call it just, a no trend, but whatever. Basically, relatively equal highs, relatively equal lows. We're not advancing. We're not really declining. Now, this is where option trading can really take advantage of things, because you can make a lot of money in sideways markets by option strategies. But from a directional standpoint, the only directional trade would be buying at support, selling at resistance, right? So you're a buyer on the bounce here, you're a seller up into resistance. You can play that neutrality that way, but ultimately this is better for option trading. We do have a class, our 8th session will be on neutral market moves. So now we're going to dive into pivot points. When you think about pivot points, think about what that really means. So think about a basketball player changing direction, right? I keep one foot there and I basically pivot around and look in a different direction, follow a different course. So a pivot point is the center point of any rotational system. A pivot in ice skating or a pivot turn in dancing. In technical analysis, a pivot point is a time when a price or market trend changed. So it's literally the change from supply to demand or vice versa. So you have a stock that is it has too much supply, we'll say. I'll make a little drawing. It drops for a few days, and then demand kicks in. And the buyers step in and start bidding that stock back up. Where's your pivot point? The pivot is basically right here. That's where the basketball player kept his foot and turned in a different direction. That's where supply, which had been driving the stock lower, a lot of selling pressure and not a lot of buyers, shifted, and buyers started to overwhelm the sellers. So in technicals, we certainly focus on these pivot points as defining trends and identifying price action. You can do it through a few different types of charts. First, we have a simple line chart. And I like to show this line chart because, if you look at the price action, you just take out all of the choppiness. Think about this like a mountain range. Okay, if you were looking up a mountain range, these peaks would have names, right? So you get different names if you're a significant peak. But not all of them are. Would they give, this little hill a name? Look at some of these little, they're little bumps and whatnot. Would these all get a name? Well, no, they're not the highest point. Nobody really cares if you climb to the 4th highest point on a mountain range. They want you to be at the top, right? And so these peaks are what get the name. These are the ones that are significant. And then you have the valleys. You have down at the bottoming point. And those are your swing lows. And nobody really cares about the insignificant ones, right? So no one really cares about this low too much, or this low all that much, or this low. What they care about is this one. This was the bottoming point. This was the Grand Canyon, so to speak. So anyway, when you look at pivot points, it's as simple as kind of drawing a line, just like we've done here. This is just a line chart, but just think about measuring dot to dot. So if you change the chart type, don't get overwhelmed by all of these candlesticks. Look through that and just say, if I was going to drag a line and just drag a line over this from dot to dot, what would it look like? Well, for me, it would look like this. And so that's why those are the pivots that I've circled. Those are the peaks and the valleys that stand out. Those are the significant highs and the key lows that make sense, right? And so now, once we've identified the pivots, it's pretty easy to see what's happening overall. We call it an uptrend. An uptrend means that as you go to a peak, it's higher than the prior peak. So you're either in a mountain range where the peaks keep climbing and climbing and climbing, or a downtrend, of course, would be the Grand Canyon, so to speak, where you keep falling and falling and falling. And it might plateau for a little bit, but then you fall further. So this is demand. This is an uptrend. This is price action that we want to look for opportunities to buy into. It doesn't mean that you just randomly, buy in at any old point, but certainly try to define where you're going to buy, what the key levels are, and get a position within those types of stocks. Now, I mentioned downtrends. Downtrends, of course, would be this chart flipped over, and this is an entirely different stock, but who cares what the name of the stock is, the company, and so forth. This shows supply. When you have too much supply, then every time it tries to rally, and it may rally for a couple of weeks here and there, it ultimately encounters new sellers which sell it at a lower high than the prior highs and then carry it to lower lows. And if you were looking at this, it kind of feels like you're standing up at the top and this is the Grand Canyon, right? You're seeing down there, and there are plateaus, there are areas where it kind of stabilizes, but ultimately it just keeps kind of falling off and falling off and falling off. That is a downward trend. I pulled up a chart not too long ago. My 7-year-old daughter was standing there, and I've never really gone through with charts or anything like that. I haven't said here's supply and here's demand, here's uptrend, here's downtrend, but I pulled up a chart that was very similar to this one, and she goes, "Oh, that doesn't look very good." And I thought, she's 7 years old, and she already knows that this, for whatever reason, is not a good thing. And so in terms of trading, I hadn't talked about support and resistance and uptrends and downtrends and so forth with her, but she just understood that this was falling. So if you kind of simplify, is it moving from the lower left to the upper right? Then it has demand. If it's moving from the upper left to the lower right, it has overhead supply, right? And then you get, on occasion, a sideways market or stock. It's range bound, it's indecisive. Usually you'll see moving averages just kind of crisscrossing in here and moving sideways and kind of mindless themselves. And this is just, actually initially this would be more of an uptrend, and it's not uncommon to take a breather. So if we were to go back a little further, you can see the advance, higher highs, higher lows. We were more bullish on this than bearish, certainly, but what really started to evolve was stagnation, and even, one could argue, maybe a little sign of bearish price action. Why? Because notice we started to fall off. Lower lows and the highs were stalled out. But ultimately, for at least this section, and you had a little bit of demand back in here, all of this section is just choppy, it's sideways, it's indecisive, and it's not anything that, other than option trading, For the most part, we pull up a chart like that and we say we don't want to really trade it directionally. We don't really want to be aggressive buyers or aggressive sellers. There are ways, like we said, where you can trade the ranges and have good risk to reward, but for the most part, that's an option trader's dream where they can sell volatility or do things that way. Important to identify those. Now, trend stages. We're going to dive into a few different types of stages that a trend goes through. When we talk about trend stages, we're going to break these down into what their characteristics are, and then give you a homework assignment to go and try and identify them. And we call them stage 1, stage 2, stage 3, stage 4. And the reason we do that is so that when you pull up a chart, you can think about the process. Is it in a consolidation? Has it broken out recently? And what are the characteristics of those? And then start to utilize that in trading. So basically there are 4 stages. You have what we call the countdown or the consolidation stage. This is a preparatory state. This is where you're basically consolidating, getting your ducks in a row. If you're a stock, maybe it's already been on a big run and now it's taking a breather, but there's not a strong trend in effect. This is just where it's storing up momentum, storing up energy for the move that's about to occur. And then you get the breakout. This is the liftoff stage. This is where a lot of fuel is used. And so if you think about this, there's an enormous amount of fuel to get this thing moving to the upside and to send it into outer space. Once you get floating out there and gravity's gone and so forth, then it's just orbital velocity. It's continuation of the trend. And then I would imagine, and I'm no astronaut, but I would imagine once the mission is complete and it's time to come back in, that's where you're going to use fuel once again to come back in. I always like the analogy of a runner. So I'm not a great long distance runner or anything like that, but in running, if you were going to run a marathon, the basic process would be first, consolidate. So you'd probably want to eat certain things in preparation of that, right? You'd want to obviously have been prepared previously, training and so forth, but there's probably certain items that you should eat that will store up some energy and then give it off at a slower pace. And then maybe right before the race, there are things that you should eat and so forth. But that's kind of where it's a consolidation. It's a resting period. We haven't started the race yet. Stage 2 is the start of the race. This is where we run out of the gates. Stage 3 is when it gets a little boring and a little tired, but we're still moving our legs. And stage 4 is when we see the finish line. And if you think about the bursts of energy, it's that stage 2 and stage 4. So here's what these look like broken down piece by piece. Remember that within each of these stages, there's no defined range of time or distance for any of these stages. You could consolidate for 2 weeks or for 2 months. Prices could skip, so you could go from a consolidation into a breakout and become exhausted quickly where you didn't really have much continuation. It's possible. That's not the normal pattern, but you can skip stages. These principles apply to both uptrends and downtrends, and the whole idea is to aid opportunity and risk analysis. So first stage is consolidation, or the countdown stage. This is the resting period. So, do we have everything we need? We're kind of taking a breather here, and the buyers and sellers just come to a state of non-aggressive action. So the buyers, they're still interested. The sellers, they're not overly aggressive, but ultimately we're just in a resting period. It's been on a run, now it's time to take a little breather. This often occurs within trends, and we love these sideways bases. They build up and they rest and they create that energy for the next move. So it's just a digestion period. It ends when you break out. And when you break out, that is stage 2. And stage 2, as we said before, this is when you're starting your first, takeoff into outer space. Well, it takes a lot of fuel. So generally, when you see a breakout, you'll see a couple of things. An expanded range candle. Look at this big expanded range bullish candle. And look at the volume characteristics down below. That's fuel. That is energy being pumped into that stock. Now, if we really think about what happened there, who's buying? It may not matter to you, but who's buying? Well, people that are buying on the breakout are buying. People that were short and are being stopped out are buying back their shorts. People that want a new position, people that want to add to their position, whatever. There's a lot of buyers, and you're breaking through resistance. It's well defined. When you have a solid breakout like this one on increased volume, traders expect continuation. You're at the starting gate. Do you have plenty of energy to carry you for longer pace and down the race? Absolutely. This is your earliest real trend opportunity, because now we have a fresh new breakout. We're making new highs on that candlestick. So by definition, you can jump right back in there right as it's making a new trending move. And then once you've seen the breakout, continuation can last a long time. I talked about trades going to the obscene number, the unexpected moves. Well, this is why trading with the trend is so important. There's no chance that back here we thought that that was possible. There's just no chance. If you'd have said that this thing's going up by whatever this amount was, people would have laughed at you and said, "Are you kidding? In half a year, there's no chance we go up that high." And yet it happens. It happens with frequency. So, this is holding your winners and whatnot. Or even if you're not long-term holding or whatever, which I don't really care if you capture that entire move, if you're buying the next dip and the dips that follow that and the one that follow that and so on, you had entry opportunities where consolidations, where breakouts, where pullbacks in these things were creating opportunity. So you're looking to trade with the trend. There will be people jumping on the bandwagon, that, last gasp rallies, etc., but these will last for extended periods of time. However, they don't last forever. And then you get to an exhaustion point. Usually exhaustions occur. This is mission complete. Think of the runner. He sees the finish line. You get this sudden burst of energy because you know that you're almost there, right? You can't sprint in the middle of the race. You just don't feel like you have the energy for it. But for whatever reason, towards the finish line, you're like, okay, I'm going for it. And usually that's what we're considering volume, right? That's the energy. The same thing happens on the upside at exhaustions. When you get a parabolic move, when you get the sprinter that's already run for 20, 30 miles or whatever, and he sees the finish line, he can sprint that last little distance, but what does he do? As soon as he hits the finish line, he collapses, right? So you see that big burst of volume. Well, think about what's happening. The stock broke out back here. It had continuation for weeks and weeks and weeks. Why so darn much volume up here? What's happening really? Well, this is what we call a capitulation, which is basically, they just push the stock to levels where an exhaustion was just so likely. In essence, they pushed this stock to the point where people said, all the good news is priced in. In fact, there might have been a product announcement or whatever it may have been. You get this surge that has priced in so much future good news, yet it does suck in those last buyers, people that are jumping on and saying, I don't want to miss out, this is great news. And so I would argue it's more the unsophisticated investor that buys when it's completely parabolic and volumes exploding, because they didn't get in at the more strategic point at the stage 2 breakout. They're late in the game, and the volume is, with it just standing out like that. When you see the most exhaustive style volume, massive volume, at the tail end of a move, that's not a good sign. When a stock has already gone up and is parabolic, and then you see massive volume, that is not a good sign. So you just have those late traders that are piling in, and the professional says, you know, that's it. This is why we bought in the first place months ago, sold to you, and they take their profits, and the runner and the stock collapse on the other side. So when you think about this, you know, can you identify the stages? I just pulled up a couple of charts just to kind of take you through the process. Think about the pivots. Think about the patterns. Do you identify the stages as they develop? You know, if I was to ask you at this point, you know, what stage are we in here? Or what stage are we in right here? Okay, can you answer those questions? And I'll give you some answers. What about right here? What stage is this? Well, here's the way I see it. So I'll give you the answers as I see it, and then I'll let you take the next one as well. Here's what I saw. Now, I didn't give you a ton of time, but did you see the big volume here? When I asked what was this stage, did you say stage 2 breakout right here? I hope you did, because this was a big sideways nothing. Look at the moving averages, sideways and choppy, which told us this was our stage 1 consolidation, right? We had been in a mindless, kind of choppy environment for a few months, and then we saw the explosive move. That's the starting gate. That's the runner taking off. When I asked you where we're at right here, did you know that was a stage 3? You're just in the trend, you're just buying dips, buying breakouts, pullbacks, you know, whatever. And then, when you saw this next volume, did you think, wait a second, here's massive volume, there was massive volume, this was the start of the race, this might be the temporary finish line. And it's very common to do this. Hit a stage 4 exhaustion, run out of gas, and then go right back to stage 1. And did you notice the stage 1 over here, and then the breakout that had started to occur? You notice how it starts all over again? So what would you do with this stock? What would you do going forward? Well, if this was a new stage 2 breakout, then I'm looking for a high base or a pullback or something to gain entry. I'm going to be a buyer on the next bullish great setup. Okay? Let's look at another one. As you pull up this chart, work your way from left to right. You know, think about the process, and I'll give you a little bit of time here to think about it. Remember, the moving averages, the slope of them tells you something about the stock. Remember the volume characteristics. We even have a little moving average line down there on the volume. And then think about what that volume suggests. So price action and volume, those are, as we said, those are the critical components in technical analysis. So let's start, let's kind of give some answers here. And we'll work left to right, but hopefully everyone just saw pretty sideways, you know, nothing happening here. Look at how all 3 moving averages are bunched together, very indecisive. Then we started to see the real breakout on volume. So that makes all of this stage 3, buy the dip, etc., etc. Did you notice the big volume spike here and what I'd call a stage 4? Then we went back into consolidative state, back to a stage 1. A new breakout started to emerge here, stage 2. Back to buy the dip, stage 3. And then everyone should see stage 4 style exhaustion volume and the collapse that started to happen in the stock. Sometimes the stock will collapse, sometimes it will consolidate. Let's check our work, kind of think through that process here. And, you know, like we said, stage 1, big basing pattern sideways. Stage 2, you got the breakout. Stage 3, continue to bet on the trend. Stage 4, we become temporarily exhausted. This time, didn't really collapse, just consolidated. Fantastic. Gives us a whole new refresher. The marathon runner finished one race, and now he's rested up for the next one. New breakout occurs on increasing volume. That puts us back in stage 3 buy the dip mode. and then a big exhaustion occurred. And this one doesn't look like it's going to go back to a consolidation. This one looks like it may reverse the trend entirely. When you pull up a chart, you can start to put them into categories and start to identify what stage you believe the stock is in. So our agenda, we're now going to conclude. Before we do that, on our conclusion, we want to give you a little bit of homework, some things that you can work on in your own time. So first, the Maverick way. Profitability comes from two things: creating an edge, right? All we can do is increase those edges, create a fat tail on the profitable side and a skinny tail on the negative side, as we talked about before. And then managing your risk appropriately. Smaller losses, bigger gainers equals successful trading. No single trade is meaningful unless you completely screw it up. Rob tells a great story about, is this the hill you want to die on? Is this the trade, the stock that you're willing to bet it all on? Why would you? No company, no opinion is so important that it should be, make or break for you. Consistency is key. Keep those emotions in check. Second, trend analysis, top-down approach. We look at markets, and markets dictate a lot of where we manage our money. We want to be positioned with the market. If we're bullish on the market and all of our positions are bearish, something's off. Something seems odd there. Statistical trend following evidence suggests that trends matter, so we want to recognize them. We can do that through pivot points and trend stages, and we want to trade with them. We don't want to be the impressive guy that catches knives by the handles as they're falling out of the air. Instead, we want to be the guy that just kind of blends in but puts on great statistically probable trades and has great risk management. So your homework assignments: pull up some candlestick charts and start applying what you've learned. Start with a 6-month daily chart and think through the process. For example, can you identify the overall trend? So you should be looking at those peaks and valleys. Think about, is it a mountain range or is it a big valley, the Grand Canyon, so to speak. Look for pivot points, formation of support and resistance, and then look for stages of the trend. Can you identify when we're consolidating into a stage 1, where there are breakouts and where the stage 2 patterns were, where you're just continuing within a trend, or stage 3, and what are the exhaustion points, or stage 4. Start to pull up some random charts and identify those things, and if you can put it into a category, then you know the trade, you know the management, you know the opportunities. Because if I know that we just had a breakout, then I know what comes next is trying to gain an entry into that position. Frankly, I might already be in the position because I might have bought on the breakout itself. That's it for today. I hope you've enjoyed this. I've tried to kind of work the questions and things into the presentation. We've covered a lot of ground, so I hope this has been helpful. As we always say, if there's any additional questions or anything that we haven't answered, feel free to shoot us emails and so forth. Stick with it. Keep at it. Work these things into your systems, what you're going to be trading, and you'll see the fruits of those labors. We'll see you next time. Goodbye, everyone.